Okay, good morning everyone. This is the briefing for the 12th of January 2018. It's my first brief of 2018 and it's been an interesting couple of weeks on the market so far. So what I'll be going through today is this continued downside we've been seeing in the bond market, why it's sort of existing, what we saw from the ECB yesterday, what trading opportunities I thought were quite good in the DAX, given the fact that we had some good correlated moves in the market. Then we're going to be looking at oil prices, what a big move yesterday, taking out some very, very key levels. Finally, then we're going to look at the US data coming out, which is your CPI inflation and retail sales. So starting off, we're going to be looking at what we saw yesterday. So I'm going to have a look at the bond markets to start with, just given that since 2018 we have been seeing some continued downside in the bond market. So as you can see, this is T-notes on a weekly chart. We've taken out the 2017 lows. We're now trading below their printing, just lower. In terms of tradable opportunities, we're coming in for that sort of retest, the 2017 lows.
Keep an eye now on your did mention.
On the downside, what you can see is we got the lows here from 2013, 2014 being tested, and these levels here are just being tested given the fact that we are seeing a global tightening of policy from the ECB. The Fed has already hiked 3 times, communicated they're going to hike 3 more times this year, coupled with the fact that we're seeing the US equity market continue to ramp higher and higher and higher. So a little bit of a risk-off trade here, but generally led by global tightening of monetary policy. Looking at your European bond market, we've got the Bund here. If we put it onto a similar time frame on your weekly time frame, we can see 2017 lows are still just a little bit, more downside to go there to reach the 2017 lows. But we are testing a key level here. Triple bottom throughout 2017. This 160.25 provided key support. Just tested it this week or just yesterday, given the fact that we had that downside following the ECB minutes. And the ECB minutes were surprisingly hawkish. Some of the key points to take away from it were that the ECB meeting showed that there was widely shared view amongst ECB officials that governing council communication would need to evolve gradually without a change to sequencing if the economy continued to expand and inflation converged toward the governing council's aim. It also went on to say forward guidance could be revised early in the coming year, which is 2018. So this is just on the back of this phenomenal growth we've been seeing in the euro area, sort of month after month throughout the whole of 2017. Consumer confidence picking up, your PMIs coming out healthy from your sort of major European economies, and inflationary pressures starting to build up. And it's good to see that the ECB is finally starting to change their stance and turning just a little bit more hawkish. So what we saw in the wake of these comments, if we look at the bond market on a 60-minute chart, at 12 o'clock, so midday when the minutes came out, immediate downside, and we really have hung on to most of these losses, still trading right here at the bottom on this really important technical level. In terms of tradable opportunities, I found this to be quite an interesting move. I was on the mic just after the ECB minutes yesterday, and what I've got here highlighted is the euro dollar on a 2-minute chart, the Bund on a 2-minute chart, as well as the DAX on a 2-minute chart. So 12 o'clock, here we see the minutes, 12:30 the minutes are released, and this has been interpreted by the market as hawkish. So as to be expected, appreciation of the local domestic currency, which is the euro, downside in the bond market as we sort of start to price in a reduction of the QE program, which right now is running till September 2018, but sort of open-ended, so they could continue to the end of the year. But given these hawkish commentary, it increases the likelihood that the QE program will come to an end finally by December 2018. So as the biggest buyer of bonds in the market steps away, we start to price that in. We see bunds start to fall, euros start to rally, and if we stretch these charts out, one of the best opportunities I've seen, for the whole year, was the bund breaking through pivot and maintaining a downward trajectory, the euro rallying quite sharply higher, breaking through pivot, sustaining itself above pivot, these 2-minute candles. And if we look at the DAX, This is how much the DAX had moved in the first 2 minutes. Right at the top of a very important pivot level, top of the range, euro strengthening, bunds falling. The DAX hadn't really responded for at least 4 minutes before finally, you can see, wasn't an aggressive move, but nevertheless highly tradable, getting in short anywhere near the top of the range. Good risk reward trade, putting a stop behind the pivot level, looking to take it down sort of to the low of the day and S1 below that. So that would have been a sort of great trade that hopefully some of you did capitalize on. I was watching some of the live guys and some of the stage 2 guys, and for sure there were some people who managed to capitalize on that. So that would have been one of your major volatile events yesterday. If we look at what happened to the euro, appreciating, we went up to go test Wednesday's high over here, and then we just sort of loitered around this level, hovered around, and it was really the lower PPIs, the month-on-month, the year-on-year headline, the core month-on-month, the core year-on-year headline, all being a miss. The year-on-year headline print quite notably. And it was the euro strength given by the ECB hawkish commentary, as well as the dovish, or the lower inflation numbers that we saw, which drove the euro further higher. So this continuation of euro strength against the dollar caused a divergence in the US equity market and the European equity market, which we can sort of see taking place at the moment. If we have a look at the DAX, at the moment it's trading session lows. It seems like quite a bit of downside momentum here. Just testing the late evening's lows here, or yesterday's S1 on the downside. However, US equity continues to ramp higher and higher and higher and higher. And actually, this morning we saw another little leg higher here as we reclaimed the 25,600 level. Immediate upside, taking us to R1, now trading above it, just consolidating, but no real retracement. People are holding on to these longs, expecting it to continue as the day sort of progresses. So this FX play is what's causing this divergence between the Eurozone equity market and the US equity market. And sooner or later, you know, I do expect that the ECB I was about to say the ECB cannot continue this hawkish commentary if the euro continues to appreciate. But what we have been seeing is the euro has continued to appreciate, and sentiment has remained strong, industrial production has remained strong, your PMIs from euro has remained strong, so the eurozone being extremely resilient. But this is really the danger by them taking away the accommodation too quickly. It will take an effect on the growth, and you can see that sort of in your equity market. But to put it into perspective, we're still very much trading right up here at the top for the DAX. So yes, we are seeing a little bit of downside as we see these big moves in the euro. But once this sharp, aggressive moves in the currency pair sort of subside, we will start to, I feel, see the equity market recover as we see the aggregate demand for products start to increase with the strengthening economy. In terms of yesterday's market, I sort of wanted to talk about oil, which saw quite an incredible move. So having a look at the oil market, got this on a weekly chart, taking out some very, very key levels here. This was the high we saw from May 2015, which was broken, as well as the low we saw in May, coincidentally, 2010. Just mark those two horizontal lines. So going on the smaller time frame, we can see here that on the 9th, so a few days ago, just taking out that 2015 level, and then we've continued to then rally, break past the 2010 levels. Having tested that level, however, we are now trading considerably lower. So a bit of a retracement, seeing some profit taking coming into the market. Just trying to get to terms with why this oil market has moved so aggressively. And this is just the global growth story, really. The global growth story plus the intervention we've seen from OPEC, non-OPEC members. So just having a look at some Bloomberg articles here. So Despairing Act takes oil to $70 while China tops US as buyer. So to put this graphically, if we find this other, China set new records for gobbling up world's commodities. So we're looking at oil right now, but I think this article is quite interesting. So having a look at this chart here, we can see the amount of imports of oil between comparing China and the US. So over here we can see in 2005 the US was a giant in terms of its importing of oil compared to China. And then year on year we can see that China has imported more and more and more and more and more from 2015 all the way through to 2017, while we've seen the US import less and less and less. And this is by part due to the fact that shale oil was quite disruptive technology and has allowed the United States of America not only to now create or produce oil domestically, but also now to export, so lesser demand for imports. But the China import story is quite key here, because oil still being one of the cheaper commodities to fuel growth. This high demand for oil is just basically fueling the growth of China. They've also been importing huge amounts of iron ores, so 1 billion ton of iron ore again in 2017 to hit a new record. So iron ore ramping higher, so demand for these commodities is what grows these economies. Also looking at gas imports year on year and year increasing. Metal buying, so once again metals going up. So what we're seeing here is China is just eating up these commodities, which is a good indication that we are still very much in a growth period in the global economy. If they continue to buy goods, they're going to use these goods to manufacture products and then sell those products. And this increase in supply is as a result of an increase in demand. And so flicking back to the charts, it's sort of understandable to see that with this OPEC, non-OPEC agreement and this propped up oil market, oil continues to ramp higher. But then also looking at the data set, we had the Department of Energy numbers come out on Wednesday, as usual. Now, the event was not very tradable. It was a mixed bag. Your headline crude figure was a drawdown of 4.9 million barrels versus the APIs the previous night, which were around 11 million. So effectively a lesser draw, resulting in a build of 6 million. So that would have a negative effect on oil prices. But then at the same time, we saw US output production decrease by 2.9%. So as a data set goes, that data set was very difficult to trade, because the headline was initially bearish for oil prices, but then if you look at the the US output production, that then decreased, which is net positive. But I think the short-term tradability of this data set was very difficult. But the medium-term tradability was the fact that, yes, we still saw drawdowns in stockpiles of crude in the United States. So this is week after week of reductions in the stockpile, coupled with the fact now that US output production decreased by 2.9%, almost 3% week on week. This is in light of the fact that oil is now trading around $60, or right up at its highs of 2015 levels. So even though oil prices are so elevated, we're seeing US shale markets start to disappear and not capitalize on these higher oil prices. And US stockpiles are also decreasing. So I think this move, or this further leg higher, is completely understandable when looking at your Department of Energy numbers that we saw on Wednesday. So that sort of wraps it up for the markets. The US equity market, once again, all-time highs. Quite an aggressive move for the morning, but just taking some technical levels out here in the Dow Jones. With your lower PPI numbers last night, the market seems to be pricing in a slightly lower CPI number, which is the main data set on the calendar today, along with retail sales. So just having a look at the calendar for today. Very quiet morning. Data set coming out 1:30, which is your inflation numbers from the United States. These are going to be your key numbers for the rest of the year at the moment, with the market sort of looking for 3 interest rate hikes from the Fed this year, but there are some outside calls for that being reduced down to 2 if inflation does start to pick up, given the fact that the growth in the United States is actually very strong. And as Deutsche Bank has explained, looking at the numbers previously, growth normally takes about 18 months to filter through into inflation, which brings us to Q2 of 2018, where we should start to see inflationary pressures build up. But just having a look at your headline year-on-year inflation numbers, the expectation or the consensus for these numbers being 2.1%. So holding on to this higher inflation we've seen since mid-2017. In terms of tradable opportunities, I think it's quite, especially with a lower number. If we get a lower number on your headline inflations, well, generally speaking, I don't advise people to trade US equity on any tier 1, tier 2 data. But in this situation, if we get a number sub 2, well, long US equity, this just means more accommodation for longer. In terms of looking for long-term volatility for 2018, what would provide us with more volatility going forward is a higher number as we start to price in further tightening. So at the moment, the inflation numbers expected to come out nice and healthy. And if they do come out as expected, well, that puts us as sort of in our average for the past quarter, so would be hardly market moving. But looking at PPIs last night, you can see that inflation numbers can be a miss here. Your core numbers as well, consensus for 1.7%. So having a look here. As we can see, core inflation has been trending lower, but throughout the whole, well, 3 quarters of last year, just hovering around this 1.7% here. And consensus is for that not to change. If we start to see core inflation pick up, this would become more interesting, because if we did see some near-term increase in core inflation, well, this could be easily attributed to the oil prices. So core inflation coming in maybe 1.8, 1.9% being quite key. Secondary to that is your retail sales. So your retail sales month on month and year coming, month on month and year on year coming out. So your month on month reading expected at 0.4% here, and your year on year, we have a look here. Your year on year number expectations are for, there's no consensus view, but previously 5.8%. In terms of importance, retail sales, I'd be looking at year on year, given the fact that we've just gone through the Christmas season and come into the new year. The month on month number may be obviously quite a bit lower than previous month. The seasonality coming into the month on month reading, while with your year on year, seasonality will be taken out. This is comparing this year to last year as opposed to December to January. So that wraps it up for the data and sort of the price actions we saw yesterday. Sam's going to be jumping on the mic now just to talk you through some technicals for the day ahead. Thank you.
Yeah, hi guys. Just having a look at the markets. Again, similar to sort of the last couple of days in that respect. I know a few people just having a look in the chat at the moment looking about possible places to get back into this euro dollar. So let's just clear this chart up and have a look and sort of talk through that. Obviously we've had the push through. Levels not seen for quite a while, so they're going to have a stops getting run. You're going to have the impact of the positive comments out of Germany for Europe, which has also boosted that. Just lower the time frame down. Futures wise, this sort of area R1 and previous high of the day doesn't look too bad. We're just coming to the bottom of this range that we've sort of had over the last few minutes as well. So it'll be interesting to see whether this can hold, and it might well be that this could be the sort of support area that drives us higher through the high and then sort of into uncharted territory again. So Euro, I definitely prefer, well, until the day, to really prefer to look for the long. I think it makes sense right now. Sentiment over the last couple of days, following these sort of ECB, following from the ECB minutes, quite positive. Looking over, I'll just have a quick look at Euro Pound on a longer chart. The key to a further push in the Euro might well be if we can get back up to the high we saw at the very beginning of 2018 in that first week last week, but you can see the rejection from there has been quite strong. Having a look over at the pound, you can see just over the last couple of minutes or so we've had a break of that R1, so quite a strong move there for the pound. Stops getting run as well above that R1 and the highs that we had quite a good sort of triple top from the beginning of the year you see there. So could well be that little retracement for the pound to look to get in, and then you're targeting the 2018 high. Nice push above today and Wednesday's high, and then the R1 and that triple top we mentioned there. So definitely worth keeping an eye on the euro and the pound against the dollar. Moving elsewhere, having a look, Aussie dollar, we did have a bit of a breakthrough pivot this morning when you saw a bit of profit taking in oil perhaps, but other than that, not much going on, and we're back to that pivot, and it could get, I imagine, fairly messy around there. So unless we can get down lower S1s or breaks higher perhaps of these levels, my focus would definitely be on the other markets to see what happens. Looking over at the dollar CAD, hasn't quite retraced that whole move still from Wednesday evening following the NAFTA comments, but let me just see if we can get a trend line on this here to the downside. We see we're starting to get squeezed in, perhaps just coming to the bottom of that as well. So we'd be focusing here. Dollar CAD is picking up as well, which makes me want to go and have a look at what oil is doing. Just retrace, but we're currently sitting on what was the previous low of the day for oil and yesterday's level lows as well. So acting as some sort of resistance there. Longer term, or well, I should say longer term, over the next few days, I still definitely believe we can get some more upside in oil. Sentiment clearly is there. So not necessarily looking to go short for too long. Other markets that have pushed higher this morning that you would like to ideally get in on a pullback, definitely US equities. You can see the push we had just after 820, push through R1, and we've sort of been consolidating a bit around there. Just going to lower the time frame, see what we've got. High of the day. Yeah, you can see here, just starting to get squeezed in. It's not the best trend line in the world. Let's see if we can get that through there. But not a bad little opportunity if we can get a push here. You can see this start to be respected, break of that high, and then again a bit more free room to go. And the next level that you could see on the chart would be the R2 for the Dow Jones. S&P, you have a resistance level obviously just a bit before. It's same one for the Dow, where R1 just above. Slow that time frame down to 5 minutes or 1 minute. Similar sort of thing. Price just starting to get squeezed in. Not the best trend line going up from the bottom, but you can see here 1, 2, 3 tests in the Dow of that high. So if we can get a break of that, not a bad opportunity if the momentum is there. Same as the Dow and S&P, Nasdaq also pushing higher. Got a bit closer to that R1 than the others, and starting to retrace back, so it could well be previous highs of the day or yesterday that offer a good area of support if you were looking to continue that. The dollar CAD just picking up a bit again now, so worth keeping an eye on that market. If we can get down to that low, and it really does open the door to S1 and the pre-comments from Wednesday evening that I mentioned. Gold pushing on, new high just now. Let's have a look at that on the break. That's where it really picked up, the break of the previous high. So gold pushing on, and if we put this on a longer chart, you can see haven't been up here for quite some time, back to September. Let me just draw this level up here on the futures. I'm just going to pop that into the room as the next sort of key market level for the futures on gold there. So I'll just pop that in into trading line for you guys to have a look at. In terms of pullbacks, if you are to look to continue this gold trade, previous high of the day not too bad. I would say R1 looks a bit safer. You can see that's where the move really did start to push on, and the buyers took over. So not a bad opportunity there. T-notes, with gold pushing, seeing a slight bid, but nothing really going on in T-notes at the moment. This morning, I should say, obviously at this moment, not doing too much. Any questions about any of the charts, obviously pop them in the chat and we'll go through some more throughout the day, and sort of a little mini briefing at midday going over the charts, and then obviously ahead of the data in the afternoon. All these charts could easily turn on their heads depending on the US data. But have a good week, and a good weekend if I don't speak to you.